All right. Good morning, everybody. It is 9 a.m. Wednesday on August 30th, 2023. Hope you guys are well this morning. Top story this morning is what happened yesterday afternoon. Markets were sent absolutely flying yesterday off of the backs of the JOLTs report. The JOLTs report stands for Job Openings and Labor Turnover Survey, and that is a monthly report where I believe it's the Bureau of Labor Statistics who puts that one out, counting the number of job openings in the country, as well as the number of people quitting their jobs every month. And we had a big change in the downward direction. It's almost as if somebody has been warning you guys for months that the job market isn't nearly as strong as they've been telling us. Isn't it funny how that works? I hate to say I told you so, but I told you so 100 times over. I told you so. Job openings and labor turnover survey came in at 8.827 million jobs. The market was expecting 9.465 million job openings. Major miss on the number of job openings in the U.S. That number is down by 338,000 versus the prior months. Now, guys, that number last year was as high as 11 million job openings when Jerome Powell kept talking to us about the tightness in the labor market and the strong jobs market. And, you know, I've been talking to a couple of people like Travis over at Real Estate Mindset and also the Happy Hawaiian. I had him on the channel back in December, and we talked all about how, hey, these job openings, there's a really good chance a lot of them aren't real, that we saw this big step change upward in the number of job postings in the United States after the pandemic, and that a lot of that was, I suspected, and Happy Hawaiian was suspecting, multiple job openings. Because of the work from home phenomenon, the same job is getting posted in 10 different cities. And so it looks like 10 job openings, but it's really only one position. And that's been going on all over the economy. And now, as the job market actually slows, we're seeing those numbers are coming down rapidly. They're coming down in a big way. Now, in any other economy, in a free market, in a fair market, this would have been viewed for the bad news that it was. This is a bad economic indicator. To see hundreds of thousands of job postings disappear, to see the job postings going away faster than jobs are being created, meaning they're just pulling the position, they're not actually filling it, that would be a bad sign in any other world. But we don't have a free market. We don't have a fair market. We have a Fed market. And in a Fed market, bad news is good news. Because the worse things get for John and Jane Q on the street, the better things get for the stock market, because maybe Fed go burr. And that's why stocks rallied yesterday. Everybody was saying, okay, this bad jobs data means maybe we don't get that November rate hike. Maybe Jerome Powell pivots sooner. Maybe we actually get rate cuts. Maybe they're going to start printing money soon. Better pile into stocks. And so this terrible economic news that we got yesterday about hundreds of thousands of job openings disappearing sent stocks sharply higher. And you can see it in a lot of charts. You saw it in a weaker dollar. You saw it in the 10-year yield dropping yesterday. You saw the S&P, the NASDAQ, the Dow all moving sharply higher yesterday. Everybody was celebrating this bad news. Everybody except the people who are looking for work, the people who are trying to find a job, everybody except the people who need to earn money and spend it into the economy in order to keep these ridiculous valuations of these stocks up in the clouds. Doesn't matter. We don't have a free and fair market. We have a Fed market. Now, we saw the same thing also in the job quits number that came out from JOLTs. Job quits was down to 3.549 million. That's versus expectations. That's versus the highs seen last year of over 4.5 million people quitting their jobs in a month. Remember the Great Resignation? It's over. The Great Resignation is officially behind us. This latest reading of job quits at 3.54 million. That is pre-pandemic levels. The number of people quitting their job every month is back to where it was before everything went to H in a handbasket, down 253,000 in just that month. People are not quitting their jobs because people are not convinced that they'll be able to find another job if they leave their job. People don't have the pricing power in the labor market that they had a year ago, which means when it comes to labor, it's once again turning into a buyer's market, meaning the employers have the advantage at least according to what Quits is telling us. And again, if we had such a strong labor market, if labor supply was so tight, then more people would be quitting their jobs because they would have more leverage in the wage negotiation process. They'd be able to go get higher wages somewhere else. That's not happening anymore. The Great Resignation is over. And if you're still not convinced about the weaker jobs market, we just got ADP private payrolls a few moments ago. The U.S. economy added 177,000 jobs for the month of August. That is versus expectations of 195,000, so it's a miss on ADP payrolls. And guys, that 177,000 jobs we just got, that is down from 371,000 in the prior month. The job market is weakening, and it's weakening rapidly. And the stock market is celebrating this as if it's good news. It's not. If people aren't working, they're not spending money. And if people aren't spending money, companies aren't making money. And if people aren't making money, then why are the stocks going up? Again, it's a Fed market. All right, with that, let's shrink my big melon of a head. And while we're shrinking my big melon of a head, won't you please inflate that like button, guys? It really helps me out with the YouTube algorithm. And if you're new to the channel, won't you like and subscribe? Stay here a while. We do this every morning at 9 a.m. CNN Fear Greed Index is back to neutrality, even leaning back towards the greed side, currently at 51. That's up from the low 40s a couple of days ago. Check out the S&P this morning, pretty much flat. Stocks aren't really reacting. I mean, over here back yesterday morning, you saw this big run up after the JOLTs report came out. Been kind of flat ever since. Right now, the S&P set to open about 4 points higher, basically a no, never mind. But check out the long-term chart on the S&P. This is going back to about the beginning of the year, and I want to zoom in here. Check it out yesterday. We recaptured that all-important 50-day moving average. All right, so that was a major technical event yesterday. We're probably going to retest that in the next few days. So we'll see where we go from here, but watch that 50-day moving average. That's a big one, which right now for the S&P is right around 4,500. Keep an eye there. The Dow is set to open 42 points higher. That's about 0.12% to the upside. And we have got the NASDAQ is also flat to up a little bit, currently up about 12 points. Basically unchanged on the day. And by the way, guys, the NASDAQ chart, we got the same thing yesterday. We recaptured that 50-day moving average. There it is. Look for a retest of that number to see which direction the NASDAQ wants to go. And as the stocks were rallying yesterday, the U.S. dollar was weakening. Here's that JOLTS report over here on the left-hand side. As soon as that came out, wham, down goes the dollar. Dollar continued lower for most of the day. Remember, the dollar is the denominator in the pricing equation. So as the dollar goes lower, that's kind of has a buoyancy effect on the value of stocks. That's pushing the nominal value of stocks higher as the dollar weakens. The dollar weakened because it was anticipating a less aggressive Federal Reserve. Less rate hikes, less aggressive Fed means weaker dollar. So as soon as that jobs number came out and everybody sees, oh, wow, fewer job openings, the rate hikes are having the desired effect, maybe the Fed will back off. The dollar started to immediately weaken on that news. Looking over in commodities, we have got gold is a little bit higher this morning. Currently, December gold futures trading at $19.71. That's up about $6 or a third of 1%. September silver futures are up about 14 cents this morning, trading at $24.93. That's up a 0.5%. It's been a good couple of days for silver. Crude oil, West Texas Intermediate for October futures trading at $81.58. That's up 42 cents or about a 0.5%. We've got platinum is flat, unchanged on the day. Palladium is down about 1%. Not a lot happening in commodities this morning. And looking over at the bond market, we have got yields are continuing to drop this morning. Again, this is on the heels of that JOLTS report and the weaker than expected labor. We got the 30 years down another 2.5 basis points, yielding 4.22. That's after a big drop yesterday. Look at the 10-year yield, 4.098, down another 2.5 basis points today. Guys, this was 4.3 a week ago. We have had a pretty big drop in the 10-year yield over these last few days. 2-year yielding 4.85. That's down 4 basis points. The 1 month still at 5.38. And again, the U.S. 10-year yield, look what happened yesterday. As soon as that JOLTS report came out right around 10 a.m. Eastern time yesterday, big drop down, continued lower for a while. And then even this morning, we've seen the 10-year yield drop at 8:30, really around 8:20. That was on the news of the second quarter GDP numbers. The second estimate came out. It was a little bit lower. We also got the weaker jobs data, so we're seeing lower yields on that. Looking on the longer-term trend for the 10-year, again, pretty significant technical event happened yesterday. Looking right here, we broke below that prior high from back in October, and now we're heading down here towards that 50-day moving average. So watch as these lines converge, the 50-day moving average and the 10-year yield's current level, currently about 4.09. And here is the jobs data in question. United States jobs openings, or the JOLTs report. The number of job openings declined by 338,000 from the previous month to 8.8 million in July. That's marking the lowest level since March of 2021 and falling below the market consensus of 9.46. Guys, this was not a small miss on JOLTs, all right? It missed to the downside by over 500,000. A lot of job postings just disappeared. It also represented the third consecutive month in the decline of job openings, indicating that the labor market is gradually slowing after months of unprecedented monetary policy tightening by the Fed. And I take issue with that gradually number. I don't think the jobs market is slowing gradually. I think it is slowing rapidly, and I think they have already made a mistake. They've already tightened too much. I think the job market is going to continue slowing even after they stop with their rate hikes. Remember, this is a lagging indicator. If jobs are slowing now, it's because of what the Fed did a year ago, not because of what the Fed did a month ago or 2 months ago. So there is plenty more slowing where that came from. Sectors that saw declines in openings, we had business services down by 198,000, healthcare social assistance down by 130,000, state and local government down 67,000, state and local government education down 62,000, federal government down 27,000. Even government job postings are going away. Now, we had some areas that saw increases, information up 101,000, transportation, warehousing, utilities up 75. What else we got? There's some regional data here. But here, guys, look at this chart. You can kind of see it pretty well. You know, we peaked back, I guess that was December. We had 11.2 million job openings in the U.S. And all year, this number's been coming down. We had a little spike in April. Coincidentally, that's right after the Federal Reserve injected a whole bunch of liquidity following the bank failures in March. And now we are resuming our downward slide. And I just want to zoom out to about a 5-year chart. You can see, guys, job postings here on this long-term chart still historically very much elevated. We're still about 8.5 million, whereas pre-pandemic we were only around 7 million. That's that step change. That's that work from home causing multiple job postings. If that had not happened, if work from home wasn't a thing, I think this chart would be way down here below pre-pandemic levels. And we see the same thing in the number of job quits. The number of job quits in the United States decreased by 253,000 from the previous month to 3.549 million in July. That's the lowest reading in nearly 2.5 years, all the way back to pre-pandemic times. Quit levels fell in most industries, with the largest decline seen in leisure and hospitality by 183,000. That was previously some of our strongest categories, guys. Those are those low-wage jobs at hotels and restaurants. They are starting to go away. Accommodation and food services down 166,000. On the other hand, the number of job quits increased in retail, trade. Let's see, we're not going to gloss over the regional data, but let's take a look here. Let me refresh this chart so you guys can see it a little better. Here you can kind of see it. We started the year around 4 million quits a month. We've been creeping down. Again, we had a big bump after the liquidity injection. This was in May, though. Now falling again, 3.5 million job quits for the month of, these were July numbers. And I just want to show you guys the long-term trend. Let me zoom out here a little bit more. You can see here where we are, just over 3.5 million. We are back to where we were pre-pandemic. So the Great Resignation, I'm calling it, it's officially over. We had all these job quits as everybody was quitting their job and getting better paying jobs somewhere else. Ever since the Fed started hiking rates right around March of 2022, that number has been dropping, now back to pre-pandemic levels. And then this morning, we got more bad news from the jobs report. ADP, employment change, private businesses in the U.S. hired 177,000 workers. That's barely keeping up with population growth, guys. That's missing expectations for 195,000. And that's also following an upwardly revised 371,000 increase in July. So a weak jobs number. And guys, I just want to mention the ADP payroll number for the last 2 months has been way, way higher than the Bureau of Labor Statistics non-farm payrolls number. So if this is any indicator, we're looking at a lousy jobs report coming out on Friday. And that's the more important run, that non-farm payrolls that the BLS puts out. That's coming out Friday. If ADP is any indicator, we're looking at a really bad jobs number. Now, the market is still rallying on this news. Like, hey, it's great news that there's fewer jobs being created. At some point, the market may realize, oh, that's right, we need jobs to support these stock market valuations, but that hasn't happened yet. Still, the market is rallying on the prospects of a less aggressive Fed. And I just want to show you guys what that looks like here. This is CME interest rate futures. This is where they're handicapping the likelihood of another Fed rate hike. Now, right now, the odds of a Fed rate hike in September are down to just 9.5%. No surprises there. Nobody's really expecting the Fed to hike in September because they've been doing this every other meeting thing recently. They hiked at the last meeting. So nobody's really worried about September. November is the one you got to watch. And right now, the odds of a November rate hike combined, if you add the prospects for a 25 and a 50, you're looking only at about 44% likelihood of a rate hike in November. Yesterday morning, before the JOLTs report came out, this was 61% chances of a rate hike in November. Now it's down to about 44. So the odds of the Fed raising rates again in November are down substantially. The market really liked that. Again, not a free market, not a fair market. It's a Fed market. And another huge story that came out yesterday, guys, landmark decision in Grayscale versus the SEC. Crypto scores landmark U.S. legal win with Grayscale ETF ruling. A ruling by the appeals court overturns the arbitrary and capricious decision by the SEC to block the conversion of the Grayscale Bitcoin Trust, or GBTC, from a trust into an ETF. Grayscale Investments won a key legal fight in its push to launch a Bitcoin exchange-traded fund, bringing the crypto industry to the precipice of tapping billions of dollars from everyday investors. I take issue with that because that is exactly what they want to do. They want to tap billions of dollars from everyday investors. You Bitcoiners who are out there celebrating this decision, be careful. Ask the silver guys. How do those ETFs work out in the precious metal space? How did they work out for retail traders? How did they work out for price discovery in the precious metal market? I don't think this was a good day for Bitcoiners yesterday. I'm no big fan of Gary Gensler and the SEC, and I agree with the court's ruling that the decision to reject the trust was arbitrary and capricious, especially considering that the SEC had approved a Bitcoin futures ETF. How are you going to approve a Bitcoin futures ETF, but not a Bitcoin ETF? So I agree with the court's decision, but I'm not celebrating it because now that there's going to be an ETF, I have no doubt that this ETF is going to be used to siphon money from retail investors and to manipulate the price of Bitcoin. Why? Because that's what they do with all the other ETFs that track silver, that track gold. Take a look at what happened with the SLV Trust and with GLD right around the time of Silver Squeeze. These are big, giant sponges that absorb buying pressure without affecting the underlying commodity. They play games in the middle of the night during big periods of volatility, and when market buying springs up out of nowhere, the ETFs absorb that without sending the price of the underlying higher. That's what they do with precious metals. They'll do it with Bitcoin. So again, I'm not celebrating this victory. But if you want to know a little bit, shout out to Dylan LeClaire on Twitter. Here's a little excerpt from the reading. They wrote, "We agree the denial of Grayscale's proposal was arbitrary and capricious because the commission failed to explain its different treatment of similar products. We therefore grant Grayscale's petition and vacate the order." Now, I just want to add, guys, that the Bitcoin ETF has not been approved. They just overturned the SEC's rejection decision. The court told the SEC, you didn't give us a good enough reason to reject this. That doesn't automatically mean approval. The SEC could challenge this, or the SEC could come back and reject it for a different reason. And I have every expectation that that's what they're going to try to do. But still, this was a big victory for the people who were trying to get this ETF passed. Now, we did see a big run up in Bitcoin yesterday. See that big green candle up? Bitcoin was up big on this news yesterday. Although I would point out, guys, check out that 200-day moving average. It shot up above it, and now it's trading just below it. So the technicals, the resistance of that 200-day moving average, at the moment, it's holding on this retest. We'll see if we continue to break higher on this news or not. Also, something else I want to talk about. I saw this one from the Kobayashi letter yesterday. Shout out to my moderator, Mish, who caught this one. Talking about investors buying houses. And by the way, the Kobayashi letter, this is a great feed on Twitter. You guys should be following this one. Just in, 26% of all single-family home sales in the U.S. during the month of June were purchased by investors. Investors are buying and renting single-family homes. Meanwhile, median rent prices in the U.S. are approaching $2,000 a month as buying becomes affordable. The housing market is forcing buyers out. Now, on its surface, a lot of you people may be thinking, oh, this reminds me of 2021 when, the big fad was that BlackRock was buying all the homes. It wasn't really BlackRock. It was Blackstone. It was a lot of other investors, but BlackRock was kind of taking the heat for it. But you had institutional buyers buying single-family homes. I don't really get the creeps from this because I think these people who are buying these houses right now are going to get hosed. I think they're going to get absolutely wrecked by this housing market. And look at some of the numbers here. First of all, I think what's going on here, these 26% of buyers being bought by investors, I'm guessing a lot of these are cash buyers. They have to be. If these are not cash buyers, then these guys are royally hosed. But let's assume for a minute that these are all cash buyers, right? And that they're not taking out mortgages. They're just buying the house up front. The median home price in the U.S. right now is about $400,000 for the median home price. And if the median rent is about $2,000 a month, that means these investors are buying these houses for 200 months of rent. That means even if every penny they collect in rent is 100% profit, it's still going to take them almost 17 years to recover their investment. That's assuming no property taxes, no maintenance costs, no administrative costs of doing businesses, no income taxes. I can't believe what these investors are paying for these homes. And these guys are going to get wrecked. There's no way they're going to turn a profit on these. And if they're borrowing money, if they're actually taking out debt to buy these homes, then these things are going to be cash flow negative. I think these investors are going to get wrecked. That is, unless the Fed lowers interest rates back to zero and they're able to refinance, or unless they start going burr again and they start printing money, sending home values even higher. But I don't think they're going to do that just yet. A lot of people are betting that that's going to happen, but I think the people that are betting on this are going to get destroyed. The numbers just don't lie here, guys. 200 months of rent to buy the median house. No way. There's no way these are going to be profitable. Not without something majorly. Maybe these guys know something I don't. I don't know, but something needs to change for this to be a good business decision. And last but not least, another story, guys, of layoffs. This one out of North Carolina. North Carolina Furniture Company closes unexpectedly with 500 layoffs. Second furniture company to close this month. Not a huge story here, guys. 500 layoffs. We've seen stories of thousands of layoffs. But this is the second one in a month in just North Carolina in just the furniture business. This is a North Carolina furniture company called Mitchell Gold and Bob Williams closed permanently, leading to the layoffs of 533 people. Now, this is just within a couple of weeks of another company, Ashboro-based Klausner Furniture. They closed on August 7th, laying off 884 people. So you got two furniture manufacturers in North Carolina closing within a few weeks of each other. This is the housing market freezing up. If people aren't buying new houses, then people aren't buying new furniture for their new houses, and the furniture manufacturers are hearing it. This is just another way that the Fed and their rate hikes is destroying people's lives. Here's 500 more layoffs plus 800 at the other store. That's 1,300 lives, 1,300 families thrown into chaos by the Federal Reserve and their rate hikes and the effect that it's having on the economy. Oh, and don't forget, for those 1,300 people, inflation hasn't gone away, so now they still have to deal with the higher cost of living, and they just lost their job, all because of the Federal Reserve. This is how central bankers just move people around like pawns on a chessboard without any regard for how many lives they're destroying. In a free and fair market, this would not happen. That's why I always use the hashtag and the Fed. And I got a couple people I got to say thank you to this morning. I want to say thank you to Mr. Mike Binder from Robin RC BatSafe. Says, good morning, Jack. Don't forget that between the VID, Infra, CHIPS, and Inflation Relief Act, or the Inflation Reduction Act, the U.S. government authorized $3.3 trillion in fiscal spending, propping up stocks. That's correct, Mike. They're not just propping up stocks. They're propping up the whole economy right now. And, Jerome Powell was hinting at this in his Jackson Hole speech when he talked about GDP growth being substantially above trend. We all know that GDP growth is being driven by debt spending from government. If the government were to just suddenly start operating on its budget without any new deficit spending, we would swing to about a 7% decline in GDP. That's how much debt the government is taking out on an annual basis to prop up the economy. Keep in mind, guys, GDP only shrank by about 4.5% during the global financial crisis. So just the mere act of the government balancing their budget would cause the biggest recession since the GFC. That is how ridiculously dependent our economy is on more and more government debt. Thank you very much, Mike. I appreciate the super chat, the support of the channel, sir. And also, guys, I have to say, don't forget to get your tickets for the Silver Symposium. Just 30 days away on September 29th to October 1st at beautiful Caesars Palace in Las Vegas. All your favorite financial YouTubers are going to be there. Come on out and let's talk. Let's get a beer afterwards. Let's have a good time in Las Vegas. If you use the link that's down in the description below, I'll also pin it in the comments. That's an affiliate link. You will get 10% off your tickets, and I will see you guys in Las Vegas. And that's about all I got for you this morning, everybody. I want to say thank you very much for your time. Thank you, Mike, for the super chats. Also, thank you to my Patreon supporters for everything you guys do for the channel. Looking forward to talking to you this afternoon on our weekly Zoom call on Patreon. Link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.